Using buybacks to increase your probability of success. Buyback blackouts and buybacks. How do they work? Well, number one, companies don't have to have a buyback blackout and they don't have to buy back stock, but it's all about confidence in the economy or confidence in the administration. So no matter what you think about controversial policies, if companies are confident, then they're more likely to buy back stock. So how do you know if they're confident? Well, go and look at the news right now. Companies are buying back their own stock at a record pace, 1.1 trillion. Holy Toledo. Now, not just that, go put in $500 billion buyback and watch what happened. Now, you're not going to believe this one, but this came out on May 6th before the markets went up. Before the markets went up. So companies were confident the tariffs weren't going to destroy the economy. And sure enough, that's when the markets really took off. So the next thing to notice in here is, what's that mean now? Well, what it means is bad news is less likely to make markets go down when companies have a boatload of stock to buy. And that's exactly what you're seeing. You're seeing less of that happen. So what happens when you have the buyback blackout? Well, a lot of people get this wrong, and I thought I'd go over it as quick as I can. Lack of buybacks doesn't mean markets have to go down. It just means bad charts and bad news are more likely to take it down because the companies aren't propping it up. So that's the way I look at it. But how do you decide when buybacks are? Well, let me show you. Companies voluntarily don't buy back stock 5 weeks prior to earnings, and most adhere to that. What are we talking about? Well, the way it works in there is for civil reasons. If Apple buys back a lot of stock and then the markets go straight up in Apple, well, it looks like insider trading. So usually 5 weeks prior to earnings, companies don't buy back stock. That's what we've seen. So let me show you some examples. So usually the earnings season starts with JP Morgan. So you could go down here and look at earnings right here. Right here. Go and look at earnings right there. And as you see, 5 weeks prior to that, what happened? This is what a lot of people get wrong. It doesn't mean markets have to go down. Not at all. What it means, if markets start to go down because of bad chart or bad news, they're more likely to go down. So let me show you. Here is 35 days. We're just going to take it here. We can take this arrow here so you sort of get it. For instance, 35 days. As you see in here, what happened? JP Morgan went up. It never had a bad chart. But go to the prior earnings. Go 35 days and you'll see what happened. The markets got rocked. Not all of it. Not all of it, but bad news is more likely to rock it. That's all we're talking about. And I'll show you a perfect example. Like I said, it starts with JP Morgan's earnings. So if you go over here, you're going to see when the earnings are. So theirs is usually the beginning. So I'll say 35 days. So we'll go buyback blackout right there. So that's JP Morgan. That starts about right in here. So October 14th, take out 35 days. You're getting to the beginning of September. Didn't add it exactly right, but just take out 14 days of October, as you see on the bottom. And take out 35 days. So you got 14 minus 30. So you're getting to the beginning of September. Like I said, I didn't add this exactly right, but you're getting in that zone. Now move it over though, because Apple's and a lot of them are like, let's say the beginning of November. Take out 35 days. So what's happening? You're getting into the middle of September. So the buyback blackout goes in this area. So what you're going to see is the beginning of September, you start to see it. You start to see this. You're going to see their earnings right here, October 14th. Move it over from here. 35 days in that zone. Right there. Just take out 14 minus 21 days. And you're going to see you get to about September 9th. Let's say the beginning of September. Just take 35 days. Make it easy on yourself. Now we're going to correspond that. We're going to take over here. We're going to take November 6th and take out 35 days right here. Right there. And that's about September 18th. So when are the maximum S&P stocks not buying back stock? Really right about here. Right there in about October 29th. Yeah, how many times have you seen the markets crack between October 10th and October 30th? That's the maximum buyback blackout time. When have you seen companies, or let's say the SPX, start to roar? Yeah, the beginning of buybacks. Holy cow, check this out. When in November? Yep, you get the big rally right here where you get to have the buybacks. Right there. You get it in November the year before. It's not a one-off. Look at that. November. Yeah, buybacks. So that's why I'm not going to get that wildly bearish till the beginning of September, and we haven't been. We've been trying to show longs and shorts because there are still things that are rolling over, but I'll show you a perfect example, and I end on this. This is Buybacks. So what you're going to notice in here is the stock got hit on earnings, but the low was the opening. Why? Because of the Rule 10b-18. That shows that companies can't buy back, even in when they can buy back. They can't buy back the last 10 minutes, and they can't buy back the opening print. What you're going to notice if you go back 35 days, what are you going to notice? That this bearish pattern started when they couldn't buy back stock or voluntarily don't. They said they bought back 7% of their stock. Bearish pattern is more likely to work, head and shoulders top, when they're not buying back stock. Well, what was the low? On the opening print of the day of earnings, because they couldn't buy it back. It hasn't gone down since then, up $1.50. Hope you find this interesting. This is how we try to increase our probability of success. Have a great day.